Good evening. It's Saturday, January 14th, 2023. This is Rob Sin at CEO Technician on Twitter, at Goldfinger on CEO.ca. And I want to make a video this evening talking about the longer term outlook for the commodities sector more generally, talk about some broad macro themes and sort of the secular bull market thesis for battery metals, for nuclear energy, even for oil and gas, commodities generally, and precious metals. I'm going to use two research reports that have come out in the last month, one from Credit Suisse, Zoltan Pozsar, and the other one, Goldman Sachs 2023 Commodity Outlook, titled An Underinvested Supercycle. I do these videos for myself, really, to learn and to think more critically as I try to talk about something and articulate ideas to you, the listener. If you find this video of value, if you enjoyed it, please hit the like button. You can subscribe to my YouTube channel where I usually publish one or two videos every couple of weeks, generally on commodities, the broader market, but sometimes on junior mining, even on biotech. And also, if you would like to receive a weekly email, a free email with some of my macro commentary, maybe even some ideas in junior mining or biotech, please send me a message, a private message on co.ca, or you can message me on Twitter with your email and tell me that you'd like to receive it. I really only want people who are seriously interested and enjoying my commentary, so that's kind of why I'm doing it in this casual way. So we start with Zoltan Pozsar, and this is an excellent, thought-provoking report that he put together, talking about war and peace, but really drilling down on why commodities that he describes as, more specifically, the three types of gold, or commodities should include the three types of gold he describes as gold, oil, and lithium. But more broadly, he's also talking about natural gas and copper, cobalt, um, and what's driving this commodity bull market. Well, changing macro regime. Um, Suddenly, we are in an environment where inflation is higher and likely to stay higher than where we've become accustomed to it being over the last, let's say, 20 years. And the world has shifted into a more bipolar, um, regime. So it's a deglobalization theme. It's not a globalization theme. It's a deglobalization theme, which includes de-dollarization by the BRICS plus countries. So he's talking about China, Russia, Iran, Saudi. So the dollar's dominance globally, its strength, is going to be tested. It's being tested now. It's going to continue to be tested, and that favors commodities. Also, the onshoring, reshoring of supply chains. So suddenly, the U.S. is not going to be importing oil or nickel or palladium or what have you from Russia. And even a lot of the things that the U.S. has been counting on China for are now in question, are in some doubt. Who knows what's going to happen between China and Taiwan, right? So there's this reshoring and onshoring of global supply chains, and a focus on energy security, on the supply chain of critical minerals, namely battery metals. So whether it's lithium, cobalt, graphite, copper, nickel, all of this is coming into focus. Governments are making it a priority to invest and support these industries. And we're just, this is this is the first inning of this theme. So this is just starting. So for somebody to think, well, the commodity trade is done, it's happened already, I really would rethink that. And just because, 2021 and early part of 2022 were good years throughout many commodities, this is an area that has experienced extreme underinvestment for a long time, decades, an underinvested super cycle. And suddenly we're in an environment where China is reopening. China is starting to stimulate its economy again, which it was not doing the last couple of years. And it's scrapped, largely started to scrap the zero COVID policy. So it's going to go through fits and starts. It's not going to be a straight line reopening, but China is reopening. And I don't think you can underestimate the power of that for the commodity sector. We're already starting to see it in copper. Copper's gone from 370 to 420 in the last few weeks. Freeport-McMoRan, one of the largest copper producers globally, has had a really powerful start to 2023. And if we look at the weekly chart, we know that mining stocks generally, especially copper miners, had a tremendous year from the COVID crash low, March 2020 to around May 2021. Then they had a correction, then they had another little leg higher. But generally speaking, they've gone nowhere in almost 2 years. So you can look over here and look here. We're roughly at the same level as we were in Q1 2021 in FCX. So this is just now beginning to break higher from an 18 plus month consolidation that included a historic sentiment washout capitulation in June of 2022, right over here. So everybody got bearish, everybody capitulated and sold in the final week of June of last year. Sentiment really stayed fairly negative throughout the whole second half of 2022, even though stocks stopped going down. Everybody has continued to wait for the next shoe to drop, and nobody had real faith that the bottom was in and we were going to rally, right? And so this is creating a bit of this FOMO environment that we're just beginning to see last week. And I also want to, make a point that I'm talking weekly, I'm talking about years, not hours or days. But even if we go to the daily chart and look at the NIMO, which is an overbought, oversold indicator, you could say, well, stocks are overbought as of Friday's close. Yes, but it's important to understand that in a bull market, stocks can correct through either price or time. And more often in bull markets, they correct through time. So if this is the real deal, okay, and if you look at the OIH chart, daily chart, this is breaking out to fresh 52-week highs. In fact, multi-year highs. They could just go sideways for 2 to 3 days and work off the quote unquote overbought conditions and then continue to go higher. So we don't, if you're a long-term investor who believes in the commodity super cycle, you don't want to get too cute in the short term and sell yourself short. I definitely wouldn't advise selling short, but also you don't want to cut your profits short. And a lot of this recent optimism, this move that we've seen in stocks and commodities the first couple of weeks of the year, it's a lot of it is predicated on inflation has peaked and it's rolling over, right? You can see the CPI chart. It's pretty clear it had a tremendous surge of inflation there for 2 years that peaked in July of last year. We've begun to roll over, but to think that we're just going to go straight down in inflation, we're going to go straight back to 2%, is seemingly a little overly optimistic. If we look back here, so this is the CPI table. You can see that. So this is the headline inflation in all categories. You can see that inflation was just beginning to edge up in early 2021, but it wasn't until April, May that it really started to take off. And then obviously it really took off, peaking at 9.1% in June of 2022. And it's since moderated to 6.5% annual rate. So one of the potential key underpinnings of a commodity bull market in 2023 is that inflation will moderate. It'll moderate maybe back to near this April 2021 level, that sort of breakout level. If we think of technical analysis, it will revisit that breakout point around 4%, but it's not going to mean revert all the way back to 2%. So we could be living in an above historic average inflation, regime, or above the Fed's target range, but inflation has moderated enough and the trend is lower that the Fed is done tightening. And the Fed will at that point be more concerned about over tightening and damaging the real economy too much. So we might have this sort of environment where the Fed can no longer raise the cost of capital, raise the price of money. It can no longer tighten financial conditions. And we enter a regime where inflation is sticky in the 3 to 4% range as financial conditions begin to loosen. And we're getting a little bit down the rabbit hole here, but this sort of situation where you have the sticky 3 to 4% inflation with a Fed that cannot tighten further or will not tighten further, as China is stimulating and hungry for commodities. That sort of dynamic, that scenario, could be nirvana for the commodities trade, a bull market in copper producers, in uranium and uranium mining stocks, in oil and oil and gas, and then of course in precious metals and gold mining shares. So, reviewing Goldman's outlook, and I highly recommend that you read it for yourself. There's going to have to be a lot of new investment in supply. That supply is severely constrained in commodities. And even though we had a nice run there for about 18 months in 2021, early 2022, there wasn't a lot of reinvestment in the sector by the big companies, whether it's copper miners or oil producers or what have you. Companies were reticent to use their cash. They were concerned about the Fed tightening, the rising cost of capital, and the potential for a recession coming in 2023. So everybody was trying to be conservative. Nobody wanted to make the wrong move. And this is a chronic underinvestment in the commodities sector for the last decade. Some would say even longer than that. So you have supply severely constrained, especially like if we use a metal like copper, a battery metal. We know copper we're going to need a lot more copper over the next couple of decades as we electrify the grid globally and the electric vehicle revolution takes hold as the sales of EVs continue to soar. Each one of those EVs requires more than 100 pounds of copper. We're going to need a hell of a lot more copper. So we know that the demand is robust and generating compound annual growth above 4 to 5%. And supply is severely constrained. It's not going to just If copper goes from $4 to $5 a pound overnight, it's not like a bunch of new supply is going to turn on next month. This takes years to happen. And so the copper price would need to be above $5 a pound for an extended period of time. We're talking at least 18 to 24 months for there to be a significant supply response. A lot of the supply that the world is counting on, for example, again in copper, is coming from existing mines expanding, either expanding underground or just expanding their existing footprint to some exploration targets that they've now upgraded to, reserves. But there's very little in terms of new projects that have scale that is, significant at a global level. There's plenty of projects out there just sitting, either waiting for financing to be built and or permits, environmental permits, government permits to be built, but they're not green lighted. And until they get both billions of dollars of investment to be built and permitting certainty from governments, they're not moving forward, right? And there has to be some sort of incentive price to motivate that money to come in and take the risk to build a new mining project. So there's no supply response in sight. And we could say this for a lot of commodities, okay? Even oil, the supply response has been relatively sluggish. We're starting to see some things happen in lithium, but off of a very, very low level. And the amount of lithium supply that we're going to need over the next decade is enormous. So it's going to require a lot of new lithium mines to be brought online to get permitted and be built. So it's this chronic underinvestment and this potentially sweet spot, situation that we could be entering in 2023. Really, the key underpinning is China reopening and China stimulus that is going to propel this bull market higher. And one of the things that shook everyone out of the commodities trade in the second half of 2022 is the Fed tightening so aggressively. 75 bips, 75 bips, 75 bips, 50 bips. So now we're getting to the end of it. And whether it's February at 4.75% or March at 5% or May at 5.25%, I don't know. But one of those is going to be the final rate hike, quite likely. And at that point, there will be a pause. And at that point, people will say, okay, we know the cost of capital is not going to go higher. In fact, it might be going lower from here. And that will help more investment in the commodity space to take hold, especially against the combination of rising prices and easing financial conditions is sort of the perfect sweet spot for the commodities bull market to really hit overdrive. And this chart is really good because we had outflows that really began to accelerate in April and May of last year, and in many ways sort of hit their peak in Q4. And now what happens if those outflows reverse into inflows as maybe the recession fears are not as bad as thought? The recession that everybody saw coming doesn't actually come. The Fed does say, okay, 5%, that's enough. And China continues to reopen, continues to stimulate in this context of all these other secular themes where we need reshoring and onshoring of our supply chains, whether it's nickel, lithium, cobalt, graphite. all the battery metals that we need for the EV revolution. Uh, there's going to be a tidal wave of investment that's underpinned by government policy actions across, the Eurozone, EU, North America, Latin America, and that trend will only get stronger over time, but it will take years to play out. So that's why, if you're a long-term investor, if you really are enrolled by this commodity supercycle theme and some of Zoltan Pozsar's, key tenets, the de-dollarization, um, the separation between the countries like Russia, China, Iran, Saudi, and the West, then commodities are sort of at the intersection of that separation, of that conflict globally. And gold is the monetary metal that will help the BRICS plus to sort of de-dollarize. It's hard to know exactly what is driving gold the last couple of weeks. What has propelled it from 1820 to 1920? I have a feeling that some of this buying, or a good chunk of this buying, is coming from the BRICS plus. So whether it's China, whether it's Russia, Saudi, I don't know, but I get a sense that there is a bid or bids coming from places that we don't necessarily see very easily. That being said, in the short term, sentiment on gold has gotten pretty hot. A lot of people have gotten very bullish on gold all of a sudden, and the price is up a lot in the near term. So urge a little bit of caution here from the short term. But just like I said earlier in the video, bull markets can correct through time. So gold doesn't have to drop back to 1800 or 1850. It could just trade around 1900, even 1920 for a week. And suddenly the overbought conditions would cool off a bit. And that would also set the stage for another leg higher. And it's these moves where there's a steady bid, steady accumulation, price continues to move higher, and there's no easy, clear explanation aside from, well, inflation's falling and the Fed might stop hiking. Well, everybody knows that, everybody can see that. There's got to be a little bit more to this move in gold. We want to also be cognizant of the gold miners have had a very nice run. The GDX has some overhead supply between $33 and $34 a share. Agnico, one of the highest quality gold producers, has a little bit of a confluence of key resistance between 58 and 60, 5 to 10% above current levels. Newmont, big resistance at $60 a share, which is about 10% above current levels. And then IAG, so IM Gold, this is a mid-tier gold producer. It's had a stellar run of more than 150% off of its October low, but big, resistance long-term at $3 a share, closed Friday at 277. So, a lot of these gold miner charts look like they have a little more upside left in them, but also urge some caution as we come into these big long-term technical levels in multiple charts. So that's it for this video. Definitely invite everybody to read the Pozsar Report, War and Peace, dated January 6, 2023, or the Goldman Commodity Outlook for 2023, both full of great insights and good data. Thanks a lot for your time. And again, if you enjoyed this video, hit the like and subscribe button.